Here's a retirement surprise nobody asks for: the IRS deciding when you have to start taking money out. And the part that really catches people off guard isn't the rule itself, it's how many other things that single requirement can set in motion. Hi, I'm Phillip Smith, financial planner with Tide Pool Wealth Strategies. Welcome to
The Perfect Retirement Plan?
Today, we're going to demystify required minimum distributions. We'll start with what RMDs actually are and why they exist, including how they're calculated and why the math matters more than people think. Then we'll walk through how RMDs work differently depending on the type of retirement account you have. And we'll talk about why multiple accounts often create more risk than flexibility. After that, we'll talk about what really happens when RMDs show up after Social Security and pensions are already in place, including the potential impact on how much of your Social Security gets taxed. We'll also cover some of the second-order effects people don't see coming, like the shift from married to single tax brackets and Medicare premium charges. And finally, we'll talk about how we think about managing RMD pressure over time using tax planning and income coordination so this doesn't turn into a scramble later on. So let's begin at the beginning. What are required minimum distributions? A required minimum distribution, or RMD, is the minimum amount the IRS requires you to withdraw each year from certain retirement accounts once you reach a specific age. That definition sounds relatively simple, but it doesn't really convey an important reality. RMDs are the moment the tax bill you've been deferring for decades finally shows up at your front door. For most of your working life, retirement accounts work like a deal with the IRS. You get a tax deduction or tax deferral today, and the government agrees to wait. Over time, that money grows, often substantially, with current taxation. RMDs are the point where the IRS says, "We've waited long enough." They're not a punishment for saving too much or having been fortunate enough to not be heavily reliant on your IRA for retirement income. They're simply the other side of the bargain that you made years earlier. Now, let's talk about how an RMD is actually calculated. Each year, the IRS looks at two things: your age and the value of your retirement account balance as of December 31st of the prior year. The IRS publishes these charts called life expectancy tables. Each age corresponds to a life expectancy factor. Expectancy is a hard word to get out of my mouth. To calculate your RMD, you divide your prior year-end account balance by that factor. Or what I like to do is divide 100 by that factor. That's going to give me the percentage of the balance that has to be withdrawn. And then, of course, that determines what you have to pay taxes on. For example, if your IRA was worth, say, $500,000, and at the end of last year, your life expectancy factor is 26.5, which is what it is for someone who's 73, your RMD for the year would be just under $19,000. The math itself isn't complicated. What surprises people is how quickly the required percentage increases over time. Early on, the percentage may feel manageable. As you age, the factor shrinks, which forces a larger portion of the account to be withdrawn each year. So again, for example, 100 divided by a factor of 20 is now 5%. Now, this isn't because you suddenly need more income. It's because the IRS wants to accelerate the collection of deferred taxes. They let you defer for a long time. They're going to ramp up how much you have to take out as far as a percentage of the account balance each year as you get older. This is an important mental shift. The RMDs are not about what you need. They're about what the tax system requires you take out. Now, understanding how the calculation works makes it much easier to anticipate future withdrawals and plan around them. RMDs exist because retirement accounts were never designed to be permanent tax shelters. When these accounts were created, the idea was simple: encourage people to save for retirement by allowing taxes to be deferred until later in life, when income was expected to be lower. Over time, two things changed. People started living longer, and retirement accounts started getting larger. As a result, Congress has periodically adjusted the age at which RMDs begin. Originally, RMDs started at age 70 and a half. Technically, the requirement was by April 1st of the year following the year you turn 70 and a half, to make it very simple. That later moved to 72, then to 73, which is what it's currently set at. And eventually, it's going to be 75 for the younger age cohort. So if you were born 1960 or later, currently your required minimum distribution will be age 75. Each of these changes reflects longer life expectancy and changing work patterns. People are working longer, retiring later, and keeping money invested for more years. But here's a subtle point that often gets missed. Delaying the RMD age does not reduce taxes. In many cases, it can actually increase future required withdrawals. Just imagine the difference between 70 and a half and 73 when the years you didn't have to take the RMD were 2023 and 2024. The total return of the S&P 500 was 26% and then 25% respectively. If someone was invested in just the S&P 500 index, their account would have seen compounded growth of over 57%. Referencing that $500,000 IRA scenario, let's say the person was 70 and a half at the time, and so maybe that IRA grew to almost $790,000 in those 2 years. That RMD with the age 73 factor of 26.5 is now $29,700. At $500,000, it was just shy of $19,000. More time for accounts to grow means more deferred taxes waiting on the other side of that growth. When RMDs finally begin, they can be larger than people expect. This is why the years before RMD age are so important for planning. Those years represent a window of time, a window of opportunity to be proactive rather than reactive. This is where complexity really starts to show up and where many people first realize that RMDs are not as simple as they assumed. Let's start with traditional IRAs. If you have more than one traditional IRA, the IRS allows what's called aggregation, basically combining the balances. Each IRA's RMD is calculated separately, but once you know the total required amount, you can take that full distribution from one IRA or spread it across several. The IRS doesn't care which IRA the money comes from as long as the total RMD amount is satisfied. Employer-sponsored plans work very differently. 401ks and 403bs generally require RMDs to be taken separately from each individual plan. There is no aggregation across 401k plans. If you have 3 old 401ks from prior employers, each one has its own RMD calculation and its own distribution requirement, and very likely its own distribution fee attached to it. 457 plans add another layer of rules, depending on whether they are governmental or non-governmental. In many cases, they must be treated separately as well. CBs are a little bit different. You can aggregate CBs together. You cannot pull together IRAs and you cannot pull in a 401k, but you can aggregate CBs on their own if you have multiple 403b accounts. But that's the only exception to the aggregation rule when it comes to qualified retirement plans. This is why people with multiple old employer plans often face more administrative complexity than they expect. Each account has its own calculation, its own paperwork, and its own deadline. More accounts mean more calculations, more deadlines, and more chances for mistakes. And the penalty for missing an RMD can be pretty severe financially, even though the mistake is often unintentional. This is also where consolidation decisions start to matter. Not because consolidation is required, it's not, but because fewer moving parts usually mean fewer opportunities for something important to be overlooked. One of the biggest surprises with RMDs isn't the rule itself, it's the timing. For many people, RMDs don't start in isolation. They start after other income streams are already in motion. Social Security has already been turned on. A pension may already be paying out. Maybe there's even some part-time or consulting work that generates income that's being layered in on top of that. When RMDs begin, they don't replace those income sources, they stack on top of them. From a tax perspective, this stacking effect is where things start to feel uncomfortable. RMDs are treated as ordinary income. That means they add directly to your taxable income for the year. When they arrive after Social Security and pensions, they can push total income into higher tax brackets than people experience during their working years. There's also an important interaction with Social Security that often catches people off guard. Social Security benefits are taxed based on what IRS calls provisional income. Provisional income includes other taxable income plus a portion of your Social Security benefit. As provisional income rises, more of your Social Security becomes taxable. At lower income levels, Social Security may not be taxed at all. As income rises, though, up to 50% of benefits can become taxable. And then at higher levels, that number can reach as much as 85% of the Social Security benefit. RMDs are often the tipping point for some people. Someone may feel like their income hasn't changed much, but suddenly a larger portion of their Social Security benefit is subject to tax. The result is a higher tax bill that feels disproportionate to the withdrawal itself. This is why RMD planning isn't just about the RMD. It's about understanding how that withdrawal interacts with everything else that's already happening in retirement. Another major RMD issue doesn't show up on the spreadsheets of life until life changes. When a household goes from married filing jointly to single, the tax landscape changes dramatically. Tax brackets are effectively cut in half. Standard deductions are reduced. The amount of income it takes to reach higher marginal tax rates drops sharply. What does not change is the size of the retirement accounts and, potentially, depending on age, the required minimum distribution. RMDs don't shrink just because a household shifts from two people to one. The required withdrawal is still based on the account balance in the IRS tables. This creates a mismatch. The same RMD that felt manageable while filing jointly can push a surviving spouse into a much higher tax bracket when filing as a single taxpayer. This is one of the most overlooked risks in retirement planning. And it's not about pessimism, it's about realism. When we talk about RMDs as a long-term planning issue, this is a big reason why. Decisions made years earlier can have a meaningful impact on the surviving spouse's tax situation later on. RMDs can have ripple effects beyond just the income taxes. Medicare premiums are tied to income through a system known as IRMAA, which stands for Income-Related Monthly Adjustment Amount. In simple terms, higher income can result in higher Medicare Part B and Part D premiums. What makes IRMAA especially frustrating is the timing. Medicare looks at income from 2 years prior when determining whether to put a surcharge on this current year. That means an increase in income from RMDs today may not show up as a higher Medicare premium until 2 years later. For many retirees, this feels like a delayed penalty. They're already paying the tax on the withdrawal, and then later they see higher healthcare costs layered on top of those additional taxes. This doesn't mean IRMAA should drive every decision, but it absolutely should be part of the planning conversation, especially for households hovering near those surcharge thresholds. Awareness and coordination, they matter here. Without them, IRMAA often shows up as an unwanted guest. I like to call her Aunt IRMAA, the aunt that you really don't want showing up. It's terrible, terrible dad joke. I'm sorry. Anyhow, for beneficiaries, RMD rules change significantly under the Secure Act, and this is an area where confusion is very common. Under the current rules, most non-spouse beneficiaries fall under what's called the 10-year rule. That means inherited IRA balances generally must be fully distributed by the end of the 10th year following the original owner's death. What trips people up is that this does not always mean you can simply wait until year 10 and take everything out at once. In some situations, annual RMDs are still required during that 10-year window. In other cases, maybe they're not. The determining factors include when the original account owner passed away and whether they had already started RMDs themselves. For adult children inheriting pre-tax retirement accounts, the practical effect is often tax compression. Instead of stretching withdrawals over decades, income is now forced into a much shorter time frame. That inherited income often lands during peak earning years, pushing beneficiaries into higher tax brackets. I mean, think about it. Your parents pass, maybe they lived into their 80s. You are in your 50s or 60s, getting towards the end of your own career. And now you have this inheritance, which is absolutely a blessing. But the taxes that come with inheriting a traditional IRA can also feel a little bit like a curse. This is why beneficiary planning is not just an estate planning issue. It's a tax planning issue that starts while the original owner is still alive. Decisions made before RMDs begin can meaningfully change the tax burden that's been placed on the next generation. So, RMDs are mandatory, but the tax impact surrounding them is often flexible. This is where planning shifts from understanding rules to managing the pressure. One of the most common strategies is Roth conversions being completed before RMD age. By gradually converting portions of pre-tax retirement accounts into Roth accounts, future RMDs can be reduced. The key word there is gradually. Large one-time conversions often create unnecessary tax spikes for most people. Partial conversions spread it out over several years. They tend to be more effective and more manageable. This is also where timing matters. The years between retirement and the start of RMDs are often a unique planning window. Your income may be lower, Social Security maybe hasn't been turned on yet, and tax brackets, well, they may be underutilized. Using those years intentionally can reduce forced income later when the flexibility is lower. The goal here is not to eliminate taxes, is to smooth them out over time. That mindset comes directly from tax planning principles we use every day, reducing volatility, not chasing perfection. Another strategy involves coordinating guaranteed income with RMDs. Consider someone with the $500,000 in an IRA annuity paying a 7.5% lifetime income starting at age 73. That produces roughly $37,500 of predictable annual income. For many households, that income alone can cover a large portion of essential retirement spending. Now, here is where coordination matters. If that guaranteed income reduces or even temporarily eliminates the need to draw from other retirement accounts, those more liquid accounts are given time to continue growing. RMDs still apply, but the pressure to sell investments at potentially inopportune times can be reduced. This approach can be especially valuable during market downturns when selling assets feels uncomfortable or counterproductive. It's not about chasing a high payout. It's about stabilizing cash flow so the rest of the portfolio has room to work. When structured correctly, guaranteed income can act as a shock absorber inside a broader retirement plan. Now, we think about RMD planning as a coordination exercise, not a single calculation. Taxes, income timing, Medicare premiums, legacy planning, they all intersect here. This is not something that should be addressed for the first time the year RMDs begin. Quite frankly, this is why some people hire our office. They don't want to react to RMD notices or scramble to meet deadlines. They want to see several years ahead and make those decisions when they still have options. Good RMD planning rarely eliminates taxes. What it does is reduce surprises. It can also smooth cash flow and protect flexibility for both spouses and beneficiaries. Okay, so let's take some required minimum action on this. I'm kidding. I'm not here to require anything of you. First, identify which of your accounts will be subject to RMDs and when those RMDs will begin. Second, understand how your first RMD will be calculated and how that amount fits into your broader income picture. Third, look several years ahead and consider how RMD income will interact with Social Security, pensions, Medicare premiums, and future tax brackets. Awareness is the first step towards control. If this episode feels heavy, that's because required minimum distributions touch almost every part of the long-term aspects of a retirement plan. They affect taxes, income timing, Medicare costs, and even what your kids or other beneficiaries eventually deal with. The good news is that none of this is random. RMDs are predictable. What makes them painful isn't the rule itself. It's waiting too long to think about how all these pieces fit together. When RMD planning is done well, it's rarely dramatic. It's steady, intentional, and boring in the best possible way, kind of like my podcasts. Remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success, whatever that means. The perfect retirement plan for you is the one you act on.
It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purposes. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and are not representative of Typo Wealth Strategy or Cetera Wealth Services, LLC. All examples are hypothetical in nature and for illustrative purposes only. The opinions contained in this material are those of Phillip Smith and not a recommendation or solicitation to buy or sell investment products. This information is from sources believed to be reliable, as Cetera Wealth Services, LLC cannot guarantee or represent that it is accurate or complete. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities offered through Cetera Wealth Services, LLC, member FINRA, SIPC. Advisory service offered through Cetera Investment Advisors, LLC, registered investment advisors. Cetera is under separate ownership for any other named entity.